Hey, welcome to an episode of the Mark Moss Show. Now, this is different than in the content I typically put on YouTube. This is the Mark Moss Show, which I have nationally syndicated across the iHeart Radio network, as well as my iHeart podcast. If you're not regularly listening to the Mark Moss Show, then I encourage you just to search Mark Moss iHeart, Mark Moss podcast. And I'm going to be putting an episode on YouTube so you can check it out. So you'll notice the format is a little bit different. Let's go ahead and jump right into it. Hello and welcome to another episode of the Mark Moss Show, where we're talking about Bitcoin, we're talking about cryptocurrencies, we're talking about the decentralized revolution that is happening right now. We're living through this and we're documenting it each and every step of the way. Big things are happening right now as I'm taking the time to make this recording, as I'm talking to you for the Mark Moss Show, and that is the entire cryptocurrency market cap is literally melting down. It's like a sea of red. But it's not just the cryptocurrency market, it's the entire market. We're talking about the NASDAQ, we're talking about the tech stocks, we're talking about the tech darlings that are down. I think 50% of that exchange is down, or that index is down by more than 50%. Some of the big darlings there, like Zoom and Shopify and Peloton, are down like 80% or more. But even other things like gold is down. I mean, we're seeing things getting hammered all the way across the board. And even some of the big darlings like Tesla. Even Tesla is getting absolutely crushed right now. And even safe haven assets. Now today it looks like gold is doing a little bit better than it has been. But typically people think about gold as being that safe haven hedge. But yeah, even Tesla looks like it's getting absolute crushed right now, which I wonder if that's going to affect Elon Musk's bid for buying Twitter. It's down about 40% since its November high. So that's interesting. The whole world is melting down, and of course the cryptocurrency markets are being completely hammered. If you look at CoinMarketCap, which is kind of a listing of all the cryptocurrencies that are out there, you can see, what do we have? 19,400 cryptocurrencies listed here. And if you scroll through, I mean, it's just a sea of red. The only green that I see at the time that I'm talking to you right now is USD coin, USDC. I see Binance coin, BUSD, and I see, True USD. So basically we have the stable coins are the only things that are still in the green here. And that's the big story. The big story is the stable coins themselves. And so the big story is the stable coins, and in particular UST. So UST is a Terra Luna stable coin. And there's big things happening with that, and it appears to be, I don't want to say it's the cause of all the market panic. It's certainly not the cause, but it's definitely exaggerating it. So I want to break that down. I want to break down what the heck these stable coins are. We're going to talk about the different types, the different categories, how they're used, why they're used, what the government wants to do about regulating these things. And then we're going to talk about the only two that I think are the ones that you'd even want to be in. I want to then talk about it from a historical perspective, because the reality is that stablecoins are nothing new. As a matter of fact, I like to talk about history all the time. History doesn't just repeat, it rhymes. And it's rhyming and it's repeating right now. So this is nothing new. We've seen this before. So I'm going to give you that historical perspective, and then I'm going to give you the warnings and some ways that you can potentially protect yourself. So a lot to cover today on the Mark Moss Show. Thanks for tuning in. If you're not tuning in on a regular basis, then you certainly should. You're probably missing out. And so make sure to set a reminder to be with me each and every time at this same channel. So at the time of my recording, as I said, it's an absolute bloodbath. We see Bitcoin is down 28% on the 7-day. Ethereum's down 30%. Binance coin, XRP, Cardano 45%. Solana 52%. I mean, it's just an absolute murder out there. And like I said, the markets are melting down. But the big thing that's dragging down all the markets, including a lot of the big hedge funds, including a lot of the blue chip stocks like the Teslas, and including the entire cryptocurrency market cap, like I said, is this Terra Luna situation that's going on. And so let's talk about that real quickly. So the first thing is we're talking about stablecoins. So stablecoins are the big darling of cryptocurrencies. Of course, it's like this DeFi. DeFi stands for decentralized finance, which a lot of people believe is one of the biggest use cases to come out of cryptocurrencies, because supposedly everything needs to be decentralized, right? Isn't that the big technological revolution that you talk about all the time, Mark? Everything should be decentralized? Well, no, that's not exactly right. No, I do talk about the decentralized revolution, which is what we're witnessing, which is what we're living through right now, which, yes, the technological revolution is decentralization. However, unpopular opinion is not everything needs to be decentralized. Let me say that again for the people in the back. Not everything needs to be decentralized. So DeFi, decentralized finance. Okay, really? Is it really decentralized? So let's think about this. If I was going to make a loan to somebody, I should know who that person is and what the percentage chance or the risk that they may or may not pay me back. I don't think anybody listening to this would ever want to loan money that you've worked for, your hard-earned money that you've saved up, loan that out to someone who you don't know who they are, and you don't know what they're going to use it for, and nor do you know what the percentage chance, the probability of them paying you back is. That would be insane. I hope nobody here would ever think about doing that. And if you would think about doing that, I think you should rethink that. And so now think about that in terms of decentralized finance. What does that mean? Finance should be centralized. There should be a central entity that's looking at the creditworthiness of the borrower and determining if it's a good or bad deal. They should determine that one person is less risky and gets a better rate, someone is more risky, pays a higher rate. Somebody has to do that. A central entity. We don't need that to be decentralized. What other things don't need to be decentralized? Well, lots of things. For example, tracking logistics on the supposedly on the blockchain. Well, you could substitute the word blockchain for database, and so let's track them in a database, and we do that now already. Amazing, isn't it? All right, now back to the lesson at hand. So this DeFi movement, this decentralized finance movement, has really been opened up wide by what's called yield farming, and so people are chasing higher than average yield. So for example, you put your money in the bank. When you put your money in the bank uses that money to create more money by loaning it back out. Now, the bank pays you interest on that money because, of course, they're using that money to make more money. Now, it used to be that you could actually live off the amount of interest that you get from the bank. When I was a kid, you could make 8-10% on your money sitting in the bank. You had $1 million, that'd be $100,000 a year, $120,000 a year of passive income coming just from putting your money in the bank and then loaning it back out. Today, the problem is the bank gives you 0.05%. I mean, basically they give you nothing for having your money in the bank. So a lot of people are chasing this yield. How can they get a way to get this yield, a way to get these better than average returns? And so people start going out further and further in the risk curve in order to do that. They start chasing all types of risky investments, obviously options trading, cryptocurrency investing, anything they can do to try to get better returns than what the market would bear. And so they've done that. Now, this yield farming seems like a great idea. And so we have DeFi, decentralized finance. We have CeFi, which is centralized finance. So the CeFi are players like BlockFi, players like Celsius, players like Nexo, Crypto.com, etc. So those are CeFi, centralized finance applications. And the thing with CeFi is they supposedly cut out the middleman and they give more of those distributions back to you. Now, those have their own risk and reward scenarios, as DeFi does as well. Now, we're finding out first and foremost the dangers that these DeFi can pose, as millions, hundreds of millions of dollars, billions of dollars are evaporating from people's accounts right before our very eyes. So now we have these decentralized protocols. The one that's blowing up right now and dragging the entire market down with us is called Terra Luna, or its symbol is UST. Now it's grown very, very fast. It's grown very, very big because they throw out a 19.5%, about a 20% interest rate. So I can make 0% in my bank. I can make 8 to 12% through one of these centralized finance CFIs, or I could make 20% by using one of these DeFi protocols like Terra Luna, staking it on the Anchor protocol. Now, let's just ask a question. You've probably heard the saying, there's no such thing as free lunch. You've probably heard the saying that if something is too good to be true, then it probably is. So ask yourself, if the banks, which are pretty much risk-free, I mean, your money is FDIC insured, if they pay you 0.05, someone else could pay you 10%, and then Terra Luna on Anchor pays you 20%. Why do you think they can pay you 20%? Because you're taking an enormous amount of risk. And so the first thing is you always have to think about your risk-adjusted return. So there's an enormous amount of risk for doing this, and we're finding out exactly how much risk we have. So we're talking about this DeFi, and we're talking specifically about these stablecoins. So a stablecoin now means that the token itself, so in this case, this UST token, is equal to $1. And not that the dollar is super stable. We can see the prices of milk, steak, food, gas, cars going all over the place. But it's always pegged to $1. So as the dollar, that's always worth $1. Whatever a dollar can buy you, that's what it's worth. All right, now we have a couple different versions of these stable coins that I think are important to dig into before we go too far into this story. So stable coins have become very, very popular. The first one was Tether. Tether became this first one. And basically, if I give them $1, US dollar, they'll give me back a token that is equal to $1. It's redeemable for $1. Anytime I want, I could go redeem that token and get my dollar back. Now, they were supposed to be holding those dollars in an account. So they had my reserves in an account. Anytime we want, we can go exchange those. That's how it's supposed to work. Now, we've had lots of stablecoins start popping up, and the reason why they really gained a lot of popularity is if I'm in Bitcoin or some other cryptocurrency position and I'm trading, I'm in and out, it's hard to go in and out of US dollars. And so we've created this token, or they created this token that allows me to sell my position in this cryptocurrency and go into the stablecoin temporarily, and then I can go back into position when I want. And so it allows me to stay within this crypto ecosystem. Well, Tether grew really, really fast. It gained a lot of reserves, gained a lot of notoriety. And so, of course, their stablecoins popped up. We have a lot of different stablecoins. So Tether, we have DAI, which is another, well, we'll break that in a second, USD coin, True USD, DGX, and on and on and on. But I don't want to go into all the particulars of each and every coin. What I want to do is I want to break down really the two different types that we have, or really maybe the three different types that we have, okay? So the first one, which is what they're supposed to be, and what I think most people believe they are, and they're finding out the hard way they're not, is that they're backed. They're backed with dollars. So I give them $1, they give me a token. They hold my dollar until I'm ready to exchange it. Now, if they keep all those dollars in their account, that would mean they're fully reserved. All the dollars they've accepted, they're sitting in their account. That's okay, because at any time, people can go redeem and get their dollars. No big deal. The problem is when they start going into what's called a fractional reserve, meaning when you give them your dollar, they only hold on to 50 cents of it, or they only hold on to 10 cents of it, and the other 50 cents or other 90 cents, they go do something else with, like put it into another asset, or try to gamble or trade with it to try to earn more money on that float on your money. All right, so this is where the problem comes in. Again, full reserve, they have all the money, everyone go get it, no big deal. Fractional reserve is a problem. If everybody wanted to go cash in their money, it would create a run. They wouldn't have enough money to pay it all back. In addition, depending on what they're doing with the rest of that money, they're putting it more at risk, and if they lose it, they may not have your money to give back to you, and that's part of the problem. So real quickly, the only coins that I'm aware of, and if I'm wrong, please feel free to hit me up on social media and let me know. The only two coins that I'm aware of that are fully regulated and fully backed by US dollars are USDC, which is the Circle coin, and GUSD, which is the Gemini coin. So USDC and GUSD, they're both federally regulated and backed by US dollars 1-to-1. As far as I'm aware, every other stablecoin out there is not fully reserved. Now, why is that important? Well, let me tell you, so one, it's important because as we can see, UST, Terra Luna coin, is getting attacked right now. And as it turns out, they don't have the money to pay back. So instead of having those dollars, what they did is they put those dollars into another token they have called Terra Luna. So if I want to redeem my dollar stablecoin for $1, what they do is they don't give me my dollar back because they don't have it. What they do is they give me $1's worth of this new token. The problem is, what if that new token isn't worth $1? Well, that's the problem that we've run into. And that's the problem that we're seeing melt down the entire ecosystem. To give you an idea of exactly what is going on, well, before we go into that, I want to break down the mechanics of how that works. But I want to explain to you, like I said, the difference of fully reserved or fractional reserve, because I think that's a key piece. And I dig into history all the time because history continues to repeat. And there's a parallel throughout history that explains this to us. This is nothing new. The period in time that I'm talking about is in the United States, and really it happened all around the world, and it was called free banking. Free banking was a time before we had central banking. So today we have central banking, which means that we have people at the top, central planners, that are planning the entire banking system. Free banking would be the opposite. Free banking would mean there was competition. That means people could start different banks and they could have different business models and they could compete against each other. Now, you probably know which camp I'm in when it comes to that. I'm a free market person. I believe in free market competition. I believe competition makes better products, better service, better prices. Central planning, in my opinion, always fails. Well, it's not just my opinion. Throughout history, central planning always fails because it lacks the competition, it lacks the profit incentive, it lacks the information that comes in a free market system. So free banking, per Wikipedia, it says that in the strictest versions of free banking, there is no role at all for a central bank or the supply of central bank money. Central bank money is supposed to be permanently frozen. There is therefore no government agency acting as a monopoly as a lender of last resort. Sounds quite different than what we had before. And I'm going to tell you why I think this is preferable. I'm going to tell you what the history of this shows us. And then, like I said, I'm going to show you how it's exactly the parallel to what's happening today. And so in the central banking system, the central bank, the Federal Reserve of the United States, is the lender of last resort. And so if a bank were to go bankrupt, the Federal Reserve can step in and backstop them, basically print more money out of thin air to give them money to keep them from going bankrupt. Now, the historical reference of this is really going back into the 18th and the 19th centuries. It was defended by, most notably, Adam Smith, who Adam Smith was an amazing author. If you haven't read his books, you definitely should. And really, if we go back into the United States, and we saw it through Australia, Switzerland, Scotland, etc., but in the United States specifically, from the period of 1837 to 1864, that's referred to the era of free banking. Now, a lot of people, specifically people that are proponents of the central banking model and people that have been raised to think the central banking model is good, so people that have gotten economics degrees and so forth, have been taught that the free banking era was bad. That all these different banks that were starting up on their own and creating their own currencies was a big problem because they were continually going out of business and blowing up and people were losing their money. Now, that is true. However, maybe the reasons for why that happened isn't necessarily true, but basically you would have a bank open up and they would create their own form of currency, and I could choose as a person in a free country which of these free banking models I want to go with. So Bank A says, hey Mark, we're going to hold all your money for you and it's going to be always there for you, and anytime you want, you can come get it. And we're just going to hold it and we're not going to pay you any interest on that. Okay, that's my choice. They can hold it, I earn nothing. Let's say Bank B, bank number 2 says, hey Mark, we'll hold your money. However, we're only going to hold 75% of it. 25%, we're going to go do some loans, but they're going to be very, very safe loans. We're going to be very, very careful, and we're going to pay you, say, 5% on your money. And then bank number 3, or Bank C, they say, Mark, we're only going to hold 25% of your money. However, we're gonna loan the 75% out, but we're really good at this. We're gonna be really careful, but we're gonna pay you 15% on your money. So now Those are three different competing models. One's fully reserved, one's barely fractional reserved, and one's massively fractional reserved. One gives me no return, 5% or say 15%. Now I get to choose which of those I want based off of the return that I'm getting and the risk that I'm accepting, all right? So I think that's a good model. I personally do. I can choose my risk, they can operate. Now, in a free market, the bad banks will fail. They're going to make bad decisions, they're going to fail, and people will lose their money. It's going to happen. It happens all the time. People invest into things all the time, they lose their money, but it allows this competition to happen and it creates a market. One man's loss is another man's gain, unfortunately. And that's exactly what these stable coins are doing. So they create their own token, just like the free banks created their own dollars. They create their own token, and they have different levels of reserve. Some are more reserved, some are less reserved, and they have different risk models. What are they doing with that money? And it's up to me in a free market to decide if I want to use one of these, and if so, which one I want to use and how much risk I'm able to take. Now, some of the problems and complications come from, do I really know what their business model is? Is it opaque? Is it transparent? Is it non-transparent? And that's part of the thing. You always need to be able to quantify your risk. Now, that's how the free banking system works. Now, a lot of historians, most economic professors would have you believe that the free banking system failed because these banks constantly blew up and people lost their money again, which is true. And that's why we need the central bank to come and backstop all these so people don't lose their money. It's not entirely true. All right, so let me just break this down before we go into the rest of it here. So if we look at this, what really happened is that the general banking laws that the government enforced upon these banks, they made these banks operate within this structure, and the banking laws restricted their activities in a bunch of important ways. All right, most importantly, the U.S. free banks could only have one office, and they had to provide security for their notes by gold reserves, but also by purchasing and surrendering to state banking authorities certain securities the state law deemed acceptable for the purpose. So let me think about this a second. So one, they allow me to operate in a competitive environment, but I have to abide by their rules, and their rules hold back my competitive ability. So one, I have to provide reserves in gold, but also I have to put the money into whatever the banking committee, the banking authorities tell me I can put it into. Here is a big, big problem. So instead of holding all my dollars in a full reserve system, now the actual bank authorities are forcing that bank to not hold full reserves, but instead put some of those reserves into the assets they want them to go into, such as the securities generally included bonds of state governments, and it was the depreciation of these bonds that was the chief cause of free bank failures in various episodes when many banks in a state failed. So, gotta love the government. They didn't allow the free banks to operate freely. They didn't allow them to actually compete. Instead, they mandated one, you can only have one branch. Two, the money you have, you can't actually hold it. Instead, you're forced to buy risky government debt. And it was the risky government debt that went bad on them, so then the collateral they were holding went bad and they weren't able to pay their depositors back. When the depositors saw this happening, what do you think happened? The depositors went to get their money out of the banks. The run on the banks caused the banks to collapse. Whenever you have your money in a bank or in any type of asset, if you're holding Tesla stock and you see it down 40% right now, you might be freaking out. You might go, shoot, I better sell that now. I'm happy to take 60 cents on the dollar back right now because I could lose even more. And that's exactly what happens in this fractional reserve banking system. They see, oh shoot, they loaned some of the money to this government bonds. These bonds blew up. I'm not getting my money back. I better go get my money back first before everybody else shows up. Another thing that really caused free banking to fail is that the lack of branch banking in turn caused state-issued banknotes to be discounted at varying rates once they had traveled any considerable distance from their sources, which was an inconvenience. So what does that mean? So in addition, they were so restricted they could only have one office. All right, and so what happens is, then instead of two things, instead of having this economy of scale where like a bank could grow and they could have multiple offices and they could benefit from that economy of scale, the bigger problem is that if I bought Mark's currency from Mark's Free Bank in the city and then I traveled to another city, there was no Mark's Bank there and there was no Mark's currency to use. And nobody wanted to accept Mark's currency because it was 100 miles away and it was hard to travel back then. And so what would happen is someone would say, well, I'll take that Mark's currency, but because I'm going to have to drive 100 miles, or they couldn't drive back then, sorry, they had to go by horseback. Since I'm going to have to travel 100 miles to redeem it, I want a 10% or 20% haircut. Now, let me give you a modern day example of this. The US dollar is the reserve currency of the world. The US dollar is recognized everywhere around the world for the most part. I spend a lot of time down in Mexico. In Mexico, they accept dollars pretty much everywhere. There's a little place that I like to go to on the Baja Peninsula. It's about a 14-hour drive from my house. It's about, because it's deep in Mexico, it's probably 3 to 4 hours from any major town where like there might be an ATM, for example. There's no ATMs there. There's no consistent power. They don't really have any electricity. They don't have any internet. There's no cell phones. The reason why I go to this place in the middle of nowhere is because the waves are really, really good. And I'm not going to tell you the name of it because I don't want a lot of people showing up there. But I spend a lot of time there. Now, when you go there, they want pesos. Pesos is the currency of the dollar. Everybody uses pesos there. Now, in some of these places, they will accept the dollar. The problem is they're going to have to drive, they have cars now, they're going to have to drive about 2 hours to the nearest town where they could find a bank to turn those dollars back into pesos. So, yes, they'll take the dollars, but at a massive discount. And that's exactly what happened with free banking. Because they couldn't have multiple branches, it caused them to have to discount their currencies. All right, now that was a big tangent, give you a little historical lesson to show you that this is exactly where we're at today. So these banks were limited in what they were able to do because of the government regulations. And then they did not hold all of those dollars in reserve. And so that caused these bank runs and these things to happen. And so back to the stablecoins. The stablecoins are doing the same thing. They're not holding 100% of those reserves. And basically, anytime you don't have something fully reserved, you're going to open yourself up to runs. At some point, some attack is going to happen where they're going to come and say, hey, this person did something risky. There's a chance we may not get our money back, and people will start running for the exits. Like at a movie theater, if somebody yelled fire, there's 2 exits, and everybody's going to start running for those exits, and everybody will start trying to pull their money out. Fractionally reserved assets are always dangerous in this regard, specifically in this case. So like I was saying earlier, USDC and GUSD, as far as I know, are the only 2 coins that are 100% backed. Now, as a side note, I mean, just taking a look at the damage and destruction that's happened here, so the way this specific Terra Luna coin works is that I give them $1, and they don't hold that dollar. Instead, they turn that dollar into value on the Terra Luna token. Now that Terra Luna token, just a couple of weeks ago, was worth about $92, $97, $95, I mean, almost $100. Just a couple weeks ago, that token was worth about $100. So if I wanted my dollar back, they would give me $1's worth of that token. The problem is that has been absolutely plummeting. As a matter of fact, just a couple weeks ago it was worth about $100, and today at the time of this recording it's worth $1.07. As a matter of fact, we've seen the market cap drop, I mean, almost 90%. I mean, it's just a complete bloodbath on this. And so instead of holding my dollars, they put it into this risky asset. The problem is that risky asset became worth next to nothing. And now that's bringing down the rest of the market. The Terra Luna stablecoin had a valuation of about, where are we here? About 18 billion. Today it's down to about 9 billion. I mean, capital is just getting completely liquidated. Now, what's happened since then? Now, a lot of people believe this might have been an attack. And as a matter of fact, I've been having lots of conversations talking about this. Of course, it's all speculative at this point, but this is what Wall Street hedge funds do. They spot a weakness or an imbalance in the market, and they go place wagers and bets against it. They've been doing this for a long time. They've been doing it since the 80s. I remember hearing stories of corporate raiders. You have famous people like Carl Icahn who have made their name off of doing corporate raiding, things like that. Movies have been made, like the movie Wall Street was made about doing that. And they find these companies that might be over leveraged. They borrow money, they attack them, they short them, and they crush it. I don't like it. I'm not a fan of it. Unfortunately, it hurts a lot of people. But this is capitalism, I guess. Now, some risks that you need to be aware of. I think that all stable coins that are not 100% reserved are at risk. Once it happens to this one, they're going to come after the rest. So all the other stable coins, specifically Tether, I would be very cautious of holding money. If you want to hold money in stable coins, I would take it out of those and put it into one of the two I mentioned, USDC and GUSD. The other thing I'd be careful of is that this is going to cause a lot of contagion. We saw Terra Luna trying to raise about $1.5 billion to try to help prop it back up. One of the companies that was putting a lot of money in was Celsius. Now, a lot of you might know Celsius, I was referencing earlier, as a centralized finance company. Why would they be willing to put up so much money to help a competitor? Well, probably because they invested a lot of their clients' money into that protocol itself. And so they have this interest to try to prop it back up. So I'm afraid that as this continues to get worse, it might start taking down companies like Celsius, companies like BlockFi, etc. So I'd be very, very careful with where you have your money right now today. Now, it's also been dragging down Bitcoin, partially because everything's coming down, but also because they had a big chunk of their money, their dollars, in Bitcoin as well. They were forced to liquidate that entire balance. About $1 billion of Bitcoin was dumped onto the market, which has also brought that down. Now, if this continues to spread, if they go after Tether next, if Celsius gets pulled into this, if this can happen, it could really bring down the entire market cap of almost everything. This is a risk that you have to be aware of. Now, it seems like right now, from conversations I've been having today, this is having a big positive result on Bitcoin. We're hearing that people, institutional buyers, are lining up trying to get orders in to buy Bitcoin, but there could be more short-term pain before we see a turnaround. That's just the truth. I don't want to admit it. I don't want to believe it. I hope it's not the case. But I think that could very well be because the way the markets are right now, all these big hedge funds, they're looking for some way to find yield. And one of the easiest ways to find yield is to go attack these companies and make giant windfalls. It's rumored that maybe the company who did the attack on Terra Luna could have made as much as $800 million. Anyway, that's a big lesson. Only hold coins that are fully reserved. Watch out for everything else. All right, hopefully you enjoyed this episode of the Mark Moss Show that I make for the iHeart syndicated national radio network, as well as the iHeart podcast network. You can just Google Mark Moss Podcast or Mark Moss iHeart. You can find the archived recordings there. And that's what I got for you today. All right, to your success. I'm out.